Welcome to the Deep Dive, your personal shortcut to being truly well-informed. We take your articles, your research, your notes, and extract the most important nuggets of knowledge, delivering surprising facts with, just enough humor to keep you hooked. Today, we're doing a custom deep dive into a fascinating set of documents, the Q2 2025 earnings analysis for SNDL Inc. And this isn't just about parsing numbers. It's about uncovering the strategic narrative behind them, understanding what truly matters and what that means for you.
Indeed. And we'll be using a structured framework to analyze their latest earnings press release, blending the company's official data with real-time market insights. Our mission really is to help you cut through the noise and grasp the critical drivers of their performance and, well, their future trajectory.
And what a quarter it was for SNDL. Seriously. They've hit a pivotal milestone, their first ever positive operating income and net earnings. That's a pretty big deal in an industry, often synonymous with red ink. So what does this turnaround actually signify for the company and its market position? Let's unpack this. All right, let's kick things off with what we call the at-a-glance scorecard, or if you're following along with our materials, that's slide 1. This is where we grab the crucial big picture. SNDL Inc. certainly delivered a milestone second quarter in 2025, marking those first ever positive operating income and net earnings.
Yeah, and what's truly fascinating here isn't just the fact of positive earnings, but the scale of the shift. Total revenue for Q2 2025 hit $244.8 million. That shows a solid 7.3% increase year over year from $2.8 million. But the real headline, like you said, is the bottom line swing. They moved from a net loss of $5.8 million in Q2 2024 to a net income of $2.9 million attributable to owners in Q2 2025.
Wow.
That's an $8.7 million improvement. It fundamentally redefines their financial narrative.
That is a dramatic turnaround from loss to profit on a relatively modest top-line increase. Yeah. So how did Wall Street interpret these results? Did they, pop the champagne?
Well, not quite a pop, maybe, but certainly a nod of recognition. While their $244.8 million in revenue actually surpassed the consensus analyst estimate of $231.5 million CAD.
Okay, so a beat.
A clear beat on the top line, but initial analyst sentiment remains cautious. The consensus rating is a hold, which suggests that while the strong results are acknowledged, the market is waiting to see sustained performance before adopting a more bullish outlook. It's that classic show me stance from analysts.
Right, the market playing it cool despite the revenue beat and the swing to profit. That suggests the story isn't just about selling more stuff. How did profit manage to outpace revenue growth so significantly?
That's the critical question, isn't it? And it's where we see a strategic shift at play. The outsized bottom line performance wasn't simply due to a surge in sales volume. It was a powerful combination of selling more profitably and managing costs with greater discipline. The primary driver was a material expansion in their gross margin. It improved by 2.1 percentage points to a record-tying 27.6%.
2.1 points, okay.
Which means for every dollar of sales, they're now keeping significantly more as gross profit than they were a year ago.
And that increased profitability from sales was amplified by those tight cost controls you mentioned. We saw CEO Zach George talk about that.
Precisely. As Zach George noted, the company achieved an absolute reduction of approximately $5 million in general and administrative G&A costs year over year. So this combination, higher gross profitability per sale and a leaner operational structure, it created powerful operating leverage.
Right.
It allowed that 7.3% increase in revenue to translate into that substantial $8.7 million improvement in net income. It really showcases a mature, disciplined approach to their business.
Okay, so we've seen the at-a-glance scorecard and the big financial swing. Now let's dig into what was truly driving these impressive numbers. This is what we're calling the engine of profitability. For those following along, this is our slide 2. This section really highlights the broad-based improvements in SNDL's margin profile and their disciplined approach to cost management.
Yeah, this really demonstrates a clear strategic pivot from what might have been perceived as a, growth at all costs mindset to one focused on sustainable, profitable operations. Let's drill down into gross profitability first. Gross profit for the quarter rose an impressive 16.2% to $67.6 million.
16.2%.
Exactly. Notice how that significantly outpaced the 7.3% revenue growth.
Yeah.
This was the direct result of that substantial increase in gross margin we talked about, reaching 27.6%, up from 25.5% in the same period last year.
So it's not just more sales, it's smarter sales. That 2.1 percentage point jump in gross margin means they're squeezing more value out of every single transaction. It's a tangible, operational improvement that hits the bottom line.
Indeed. Management attributes this success to what they call operational rigor and focus on execution. And, well, you can see that discipline reflected across all their business units. Now, for the most significant achievement, operating profitability and the company's turn to black.
Okay.
SNDL reported an operating income of $5.0 million. This is a stark reversal from the $4.8 million operating loss they posted in Q2 2024. That translates into a positive operating margin of 2.0% compared to a negative 2.1% a year ago. This isn't just about reducing losses, it's about actively generating profit from their core operations.
And this turnaround was clearly powered by astute cost management, even as they continued to expand their top line, wasn't it?
Precisely. General and administrative expenses fell to $45.4 million from $48.0 million. And share-based compensation, another key expense, decreased from $4.9 million to $2.9 million. These combined reductions perfectly confirm the CEO's statement of that roughly $5 million decrease in G&A costs. It signals a mature operational approach. They're not just cutting indiscriminately, they're optimizing.
Okay. I also saw something mentioned about IFRS and non-IFRS adjustments in the report. What's the deal with adjusted operating income, and how does that factor in?
That's crucial for getting a full picture of their underlying performance. We call this bit bridging IFRS and non-IFRS understanding adjustments. So to provide investors with a clearer view, SNDL reports an adjusted operating income, which is a non-IFRS measure.
Right, okay.
For Q2 2025, they reported an adjusted operating income of $5.8 million. Now, the difference between their standard IFRS operating income, $5.0 million, and this adjusted operating income, $5.8 million, is primarily a $0.8 million charge for restructuring costs.
Restructuring.
Exactly. So by excluding this charge, management presents a picture of the core business's ongoing recurring profitability, stripping out those, one-time expenses. It gives investors another lens through which to evaluate performance.
Got it. So we've got the overall profitability picture. Now let's go into the engine room and look at how each specific business segment performed. This is our slide 3. It's clear that SNDL's positive consolidated results were driven by strong, almost synergistic performance across its key operating segments.
That's absolutely right. Think of it as a well-oiled machine where the cannabis division served as the primary growth engine, while the liquor retail segment provided a stable and increasingly efficient foundation, each part contributing to the whole.
Okay, let's start with what sounds like the growth powerhouse, cannabis operations. How did that segment perform?
The cannabis operations segment was indeed the standout performer. It showed remarkable vitality, with revenue surging 43.5% year over year to $35.8 million.
43%? Wow.
Yeah. And this growth was fueled by both strategic acquisitions like Indiva in late 2024, which boosted their edible sales, and significant organic expansion. International sales accelerated to $3.8 million for the quarter. And critically, this growth wasn't just top line, it was profitable. It swung from a $1.9 million operating loss last year to a $2.3 million operating income. This clearly demonstrates they're achieving impressive efficiencies and scale in their production and distribution.
And what about cannabis retail? That's where they directly interact with consumers.
Right. The cannabis retail segment delivered a record quarter, with revenue growing 11.0% to $84.4 million. And a key indicator of its underlying health and, consumer loyalty is its robust same-store sales growth of 8.2%.
8.2% same store. That's strong.
It really is. It means growth is coming from their existing store footprint, not just from opening new locations. That signals strong customer retention and effective in-store strategies. This impressive performance allowed SNDL's overall cannabis business to expand at nearly 3 times the rate of the overall Canadian market,
3 times.
indicating significant market share gains. This strength, combined with productivity initiatives, allowed operating income to more than double to $8.1 million. They're clearly winning in a competitive retail landscape.
That is an impressive feat, outpacing the market like that. But what about liquor retail? That's still their largest segment by revenue, right?
It is. Liquor retail certainly provided a stable base, with revenue growing 1.0% to $141.9 million.
Just 1% growth there.
Right. The underlying story here, however, is one of impressive efficiency rather than rapid growth. On nearly flat revenue growth, the segment's operating income jumped a substantial 30.6% to $11.1 million.
Wow. Okay, so margins and costs.
Exactly. This was achieved through improved gross margins and lower operating costs, even though they operated 5 fewer stores than the prior year. This underscores significant gains in operational leverage and efficiency within a mature market. It proves they can optimize even without aggressive expansion.
And finally, the investment segment. That always seems like a different beast entirely.
Yeah, it's simpler. For the investment segment, primarily comprised of interest earned from their substantial cash holdings, operating income was $1.8 million for Q2 2025. It continues to be a steady, if smaller, contributor to their overall profitability, reflecting that strong balance sheet.
Okay, this brings us to financial strength and shareholder rewards, which you'll find as our slide 4. It really sounds like SNDL's operational turnaround is fully backed by an incredibly strong balance sheet.
Absolutely. This is what management confidently calls a fortress balance sheet, and they correctly identify it as a key strategic advantage, especially in the capital-intensive and often financially precarious cannabis industry. As of June 30th, 2025, SNDL held a remarkable $208.2 million in unrestricted cash and, perhaps most strikingly, had no outstanding debt.
No outstanding debt. In a growth sector like cannabis, where companies often pile on debt to fuel expansion, that's almost unheard of. Does that level of conservatism mean they're maybe missing out on aggressive growth opportunities? Or is there a deep strategic advantage to this pristine balance sheet?
That's a fair question. It's certainly a strong and strategic position. While some might argue for more aggressive leveraging, look at the numbers. SNDL's total assets stood at $1.3 billion against total liabilities of only $205.3 million. Their debt-to-equity ratio, a key measure of leverage, is an exceptionally low 0.19.
Very low.
Yeah, with total shareholders' equity at $1.1 billion. This conservative financial structure insulates them from market volatility. It allows them to fund growth initiatives, both organic and through strategic acquisitions, without relying on costly or dilutive external financing. That's a significant competitive advantage over their more heavily indebted peers. It gives them flexibility to act opportunistically when others simply can't.
So they're financially strong and independent.
Yeah.
What about returning value directly to shareholders? Did they engage in any share buybacks this quarter?
That leads us neatly to their capital return strategy, primed for buybacks. Now, while SNDL did not repurchase any shares during the second quarter,
Okay, pause there.
right, they paused, but they signaled a clear, long-term commitment to their share buyback program. The board of directors approved an amendment to the program, actually increasing the maximum number of shares the company is authorized to repurchase.
So they paused buybacks, but simultaneously increased the authorization. That's an interesting move. What does that signal, do you think?
Well, it suggests a highly disciplined and opportunistic approach to capital allocation. They previously repurchased 10.8 million shares in the 2 preceding quarters, so they've been active.
Right.
The decision to pause repurchases in Q2 while simultaneously increasing authorization indicates management may have been preserving cash for immediate strategic investments, like that recently announced $32.2 million acquisition of 32 1CM cannabis retail stores.
Oh, okay. Makes sense.
So this dual action, it signals to investors that management is prioritizing strategic, accretive growth in the short term, but also believes its stock remains undervalued and intends to resume repurchases when it is most advantageous for shareholders. It shows confidence in future value.
All right. We've analyzed the past and present performance. Now, for the road ahead, management's outlook and key takeaways. This is our final segment, slide 5. It really sounds like this quarter wasn't just a fortunate fluke, but the direct result of a deliberate long-term strategy.
Exactly. SNDL's management team explicitly frames the second quarter's results not as some one-time anomaly, but as the culmination of a deliberate strategy focused on operational excellence and financial discipline. CEO Zach George described the quarter's results as a pivotal milestone that underscores the effectiveness of our strategic improvement agenda. They're clearly communicating that this is part of a plan.
So building on that, what's their concrete plan for the future? What should we expect to see next?
Well, their forward-looking commentary outlines a multi-pronged strategy for sustained value creation. Key initiatives include the pending acquisition of those 32 retail stores from 1CM.
Right, the acquisition.
Which will further expand their retail footprint and market share. They're also launching the Rise Rewards loyalty program, a smart move to drive customer traffic and retention.
Loyalty program, good idea.
And they've approved capital expenditures to fund organic store expansion where it makes sense. Furthermore, management highlighted a formal strategic review to evaluate their exposure to the U.S. cannabis market and their current stock exchange listings. U.S. market review. Interesting.
Yeah, this, combined with their strong balance sheet, signals an ambition to leverage their stable, profitable Canadian platform for future growth opportunities, particularly as regulatory landscapes evolve in the United States. They're clearly thinking big picture.
That brings us to some important takeaways for our listener. After this deep dive, what are the most critical points that really stand out for someone interested in SNDL or the cannabis sector generally?
Okay, first, the pivot to profitability is real and sustainable. This quarter was indeed a fundamental inflection point. Achieving positive operating and net income for the first time was not an anomaly. It was the result of tangible, repeatable improvements like that 2.1 percentage point expansion in gross margin and the roughly $5 million reduction in G&A costs.
Right.
This demonstrates management's strategic plan to build a sustainable, profitable company is genuinely bearing fruit. They're moving beyond that early stage, growth at any cost mentality common in the industry.
And it sounds like their core cannabis business itself is performing exceptionally well, driving that profit. It absolutely is. Second key takeaway. The cannabis engine is firing on all cylinders. SNDL is actively capturing market share. Their total cannabis business grew an impressive 17.4%, significantly outpacing the broader Canadian market.
17.4%.
And this wasn't accidental. It was driven by that explosive 43.5% growth in their high-margin operations segment and healthy 8.2% same-store sales growth in retail. This confirms the strength of its core growth engine and their operational effectiveness.
And we've talked a lot about that financial fortress they built. That seems key.
Indeed, and that's the third key takeaway. The Fortress balance sheet is a key strategic weapon. With $208.2 million in cash and zero debt, SNDL operates from a position of financial strength that is exceptionally rare in this sector.
Really is.
This provides immense flexibility. It allows the company to fund strategic acquisitions like 1CM, invest in organic growth, and maintain flexibility for future share buybacks and potentially significant strategic moves into the U.S. market without diluting shareholders or taking on high-interest debt.
But despite all this good news and a clear operational shift, you mentioned analysts still have that hold rating. Why the continued caution? What's the final takeaway there?
That's the crucial final takeaway. The market remains in show-me mode. Despite the strong results and the revenue beat, that initial hold rating suggests Wall Street is looking for consistency.
Consistency, okay.
The key challenge for SNDL moving forward is to prove that this quarter's operational discipline, the margin expansion, and these market share gains are repeatable, that they can form the basis of a long-term, predictable trend. Investors want to see sustained execution before committing to a more bullish stance.
So, in essence, it's a harvest of discipline then. Seems like a good way to put it.
Precisely. For years, SNDL pursued a strategy of consolidation and aggressive growth, often, as we discussed, at the expense of near-term profitability. This quarter's results truly represent the harvest of a deliberate and disciplined strategic pivot. The significant revenue beat wasn't an accident. It was the outcome of a finely tuned retail model outperforming the market. And the landmark turn to positive net income wasn't some windfall. It was forged through meticulous cost control and margin-enhancing operational rigor across all business segments. So while the broader market may remain cautiously optimistic, the internal data tells a clear story. SNDL is successfully transitioning from aggressive expansion to sustainable, profitable growth, using its pristine balance sheet as the foundation. The road ahead, as outlined by management, is a clear continuation of this disciplined strategy, and that's what investors will be watching very closely.
That was a fantastic deep dive into SNDL's Q2 2025 earnings. It really highlights how a structured approach to analyzing these reports can uncover the deeper story behind the headlines.
Absolutely. By moving beyond just the top-line numbers, you can identify the true drivers of performance, assess financial health, and understand management's strategic vision. It's a repeatable method for building a deeper understanding of your investments over time.
And it leaves you with a lot to think about, doesn't it? Like, what will this consistent operational discipline mean for SNDL's long-term market position, especially as they look towards the evolving U.S. cannabis market? That's a big question.
A critical question for sure, yeah.
Before we go, just a quick reminder, host, speaker, expert speaker. This report is for informational purposes only and does not constitute financial, investment, legal, or tax advice. All investment decisions should be made based on your own research and in consultation with a qualified financial professional. This report was generated by an artificial intelligence model, and all information should be independently verified by the user. Like and subscribe to stockanalytics.ai YouTube channel. Members get access to our growing library of all S&P 500 stocks and get priority requests for company deep dives.